All right, so this being given that we started already. All right, trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. Now, let's see. No special questions, so I get to start off saying what I feel like talking about, which I have no idea. But look at this market. This is horrible. Horrible. Europe just closed. They closed down over 3%, so we're down about 2%, 2.5%-ish. What I care more about, and we'll move to bigger charts in a second, what I care more about is whether we're down 5% yet, and because at 5% we want to see a bounce. And if we're not seeing bounces at 5%, that's very weak, and then we've got to be very concerned about that. One of the reasons I'm not terribly concerned about this drop-off is because look at the dollar. Here we start off at 94 on Friday. Friday morning we're at 94. Now we're at 96.5. That's a 2.5% run in the dollar. So, of course, if the dollar goes up 2.5%, then everything you're buying for dollars gets 2.5% cheaper. It's a very direct relationship. You know, if you buy something for, something is, you know this if you're in euros, right? Like if you're in Europe and you're spending money and the euro gets more valuable, less valuable, whatever, you know you're getting a discount right away. You immediately start saying, oh, it's cheaper because it went down today or whatever. But for some reason, people don't understand that works the same way with your dollars. Your dollars are just as fixed as the euros you buy for dollars when you're in Europe. And this is why people like gold, because your gold has a fixed value generally. Not these days, but, you know, once upon a time it did. So when you have cash in your portfolio and the dollar goes up 2.5%, that means logically, on the average, everything you want to buy with your cash is going to be 2.5% cheaper. Okay? Now, interestingly, though, here's the thing. People get confused about bonds. Bonds go up in price, not because they're paying a better rate and not because people think the rate's going down, but because the dollars the bonds are priced in are more valuable. If you've got a $100,000 bond and the dollar goes up 2.5%, then you have $102,500. You have a $102,500 bond. Not in dollars, but in any other currency, it's more valuable. If you have dollars and you're going to trade your bond for dollars, or use your dollars to buy bonds, then you're not really thrilled. And to you, the bond got more expensive. Why should you pay it? But to people all around the world who are the customers of these bonds, their currency is devaluating while these bonds are holding their value or going up against them. Therefore, they want the dollar-denominated bonds. This is what keeps the yen bonds strong, because the Japanese yen it's not a great currency because they borrow, they're massively in debt, but it's a better currency than all the other currencies in Asia. So, on a relative basis, people in Asia like to hold Japanese bonds. They feel like it's the way Europeans used to hold Deutschmarks. Back when they were all different currencies, people like to have Deutschmark bonds or Swiss franc bonds. They didn't like that, or sometimes pounds. But people wouldn't want to have French franc bonds. Nobody wanted those. Nobody wanted Spanish bonds, and certainly nobody wanted lira bonds because that would change like 10% a day. It's people who don't do it a lot. It's hard to wrap your head around all the little variables, but you have to realize in bonds it's very, very important that the price, when the currency goes up, the bonds get more expensive because they're priced in the currency. So they don't have to offer a good rate of interest, which makes them more expensive, which makes the bonds more expensive. They don't have to offer a good rate of interest because the currency they're based in went up instead. So if the dollar goes up 2.5%, that's like you got a 2.5% bump in interest on your bond. That's why the bonds are still attractive, even though to us it's crappy interest rates. But people don't buy them just for the rates; they buy them for the currency as well, and that's what makes U.S. bonds so perennially popular. That's a hard word. So, and then of course commodities are priced in. You got gold, you have silver, you have everything. They're priced in dollars too. So when they go down, like right now, silver's down 3%. So what? Okay, it's not a big deal. It's really still around 15, except 15 minus 2.5% is, I don't know. It's some number that's probably close to 14. It's probably more than 25 cents. So, of course it is, like 30 cents, 40 cents, I think. Calculate, let's see. So we take 15 times 0.025, 37 cents. There you go, I was close. All right, so silver should have gone down 37 cents as the dollar went up. All right, so what did it do since Friday? Well, there you go. It was here, 29, and now it's at 76. So right about 50 cents, 56 cents. So basically this is only being affected by the dollar. It has nothing to do with silver being weak. Same thing for gold. It's nothing to do with gold being weak. Same thing for oil. It's nothing to do with oil being weak. It's all just being repriced because they're sold in dollars. All right, so let me make sure I got that clear to everybody, and we'll take a look at some questions. Oh, now there's some questions. What's this? Check your local settings. I'm getting audio. I think I fixed that. John's got no audio. Oh, God, John. I don't think you guys are supposed to choose the headset mic options. I think that's just me, as far as I know. All right, anyway, I don't know, so that's the bottom line, though. I really don't understand how it works on the user end. Sorry. How come the Nikkei plummeted even though the dollar went up? That now, while the dollar in a vacuum, right? Like it's a physics, it's a chemistry thing almost. It's like in a vacuum, the dollar is going to move the Nikkei up and down, okay? But there's a lot more going on than just the dollar. So what's going on is, first of all, Japan has a lot of automakers, and automakers are getting killed over this Volkswagen thing, partly out of fear because everybody's wondering if every automaker is doing this, and they're not. I don't believe they are anyway. I'll certainly tell you the American guys aren't, and we're going to take a look at Ford, in fact. The American guys aren't because in America we have much stricter emissions testing than they do in Europe. In Europe they have really bogus emissions testing, and it's easier to slip past what they're doing. The American testing is a little stricter, and I can't imagine any CEO. I think these guys are on drugs. I mean, I can't imagine why anybody would do this. The risk is, well, we'll look at the risk. Here's the risk. How much money could they possibly have saved, or how many more cars could they have sold to make it worth the crap that they're going to go through now? It's not just a fine. This is a criminal act. I mean, they really defrauded millions of people who bought their cars. They've destroyed the company's reputation. They're going to get fined 10 times more than they ever could have made selling the cars. And they may be prosecuted. People may end up going to jail over this thing. And the reputation of the company shot to hell. I don't get it. I'm just so baffled by this whole thing. Now, maybe, I think the management, although the CEO of Volkswagen said, I'm sorry, I'm so sorry, oh my God, I'm sorry. That's basically what he just said in the press conference. I think he said something like, sorry to infinity or something like that. I don't know, somebody has to translate it properly. But he says, basically, he's really sorry. I still think even though he's taking responsibility, I do believe that their contention is that he didn't do it and the management didn't do it, but the vendor did it to them. Like some vendor sold them this system and put this thing in that would make it look good, but meanwhile it's all bullshit. But who knows? Obviously I would say that too if I was going to get my head chopped off. So I don't think that we're going to learn the truth right away. I will tell you, though, that the fact that this all came up like yesterday, or 2 days ago, I think it was yesterday, the fact this came up yesterday and today already Volkswagen's taking responsibility, that indicates to me that it's not the vendor. Because it would take you at least a couple of days to find out the vendor did something like this and to be sure that you're blaming the right person. I think, because you wouldn't immediately, you'd say we're conducting the investigation, we'll get to the bottom of this, whatever. But they're saying, I'm sorry, we did it, it's our fault. That means they probably knew. That means that either they did it directly or they already knew it was happening and they didn't do anything about it, and either way they're in big trouble. But anyway, that's playing havoc with the markets today. So part of the drop in Europe and part of the worldwide drop is that, but it could have been anything. This is why we got to cash, because it could have been anything, anytime. This is literally like these are straws that break the camel's back. There's problems in China, there's problems in Japan, Russia's a disaster, Europe is still a disaster, Greece needs more money, they're still coming to a thing. Our government is going to shut down, the U.S. government is shutting down in 8 days and nobody cares. Nobody's talking about it. It's a serious thing. They did polls today, 75% of the people who follow this thing, and these aren't economists, these are actual journalists, so they might know what's going on. 75% of the economists said something I wouldn't believe them, but 75% of Washington press people say that we're going to shut down in 8 days, that this is not going to be averted. Why would I want to be in a lot of stocks with that kind of problem? I mean, it's just crazy. I want to be in cash. I want to be ready to do something. All right, so where are we? Robert, I told you Robert to do that. Robert Forval says, oh, no, wait, sorry, Alan. All right, wait. No, you guys are confusing. There's too many people. That's right. This is a free one. There's a lot of people on. Sorry. Did you see any trades in biotech stocks or IBB? Yes, we did GILD. I know we talked about it today, so let me see if I can find it. Control F, GILD. Oh, come on. I thought we talked about that today. Isn't this today? Huh. Today's Tuesday, right? Yeah. Was it yesterday? Maybe it was yesterday. Let me check yesterday. I do know we like GILD, and I know I referred to it. Maybe it was here. It must have been like an early morning chat. Let me see. Now let's try that again. GILD. That's what it was. See, it was early this morning. That's why I got confused. All right. So in GILD, somebody had asked me a question back on the 10th. And on the 10th, we were probably around here at about, not then. On the 10th, we were probably just around where we are now, 105-ish. And the question they asked at the time in that chat was, what do I think of biotech, blah, blah, blah. And he was looking at BMY. And I said, look, I don't like BMY because they have too much of a PE. And I don't trust them not to drop considerably. And IBB, obviously, is moving along. See how these guys are totally in lockstep, though? It's barely apart from each other. And GILD is also kind of in lockstep with them. But GILD, to me, had a better PE ratio. They got more on the ball. They got a good pipeline. I like them better. So my pharma trade here, we added to the long-term portfolio, but we didn't take a big position. All we did was we sold, to start a position, we sold 5 of the 2017 80 puts for $6. 17? Oh, okay. I guess they weren't 2018s yet. If we look at GILD now, that was from a couple of weeks ago. Because if they had asked me that question early, closer to the 2018s, I would have said wait. And they still don't have 2018s. So we sold the 80 puts. Now, first of all, the stock's at 104. We sold the 80 puts, and in fact, they're back to the same price they were, so I like this trade again. But what we did is we sold 5. Let's do a sell. And we'll sell 5. And we'll sell them for $6. And we confirm it. So you see, you sell 5, you get $3,000 cash paid to you, or 6 times 500 shares. You're obligating yourself to buy 500 shares for $80, but that's 20-something% off the current price. So that's not bad. And look at the buying power effect. That's your margin requirement, $2,700. So it's what we call margin efficient. You collect $3,000, and you get hit for $2,700 in margin. So you're going to make more than 100% back on margin in, 16 months, right? So your best case is you keep the $3,000, and your worst case is you end up owning 500 shares of Gilead for 88 net 80 minus the 6 is $74. That's $74 is $30 off. You're talking about almost a 30% discount off the current price. That's how we like to buy things. And in fact, that's what I said this morning as far as in the portfolio. Because when you're in cash, then use the margin. You've got tons of margin. Use it for things like, say, you know what I'd like to buy? I'd like to buy Gilead if it gets to 80. And it's like, of course I want to buy Gilead if it gets to 80. It's at 104. And I'm not even saying 80 because I'm getting paid, so I'm really netting 74. So it's almost like a fantasy camp. It's like, well, if I can get it for 30% off, I'll take it. That's all I'm saying. I don't have to spend any money. I'm not even using any margin. I'm sitting on my cash pile, and I'm adding $3,000 to it. Now, in our long-term portfolio, that's almost all of the positions are pretty much those because we have all cash, but we promised that if certain things get cheaper, we'll be happy to buy them. And every week we do another $3,500 at the end of the year. In 50 weeks, we're doing a couple of $100,000. See how that adds up? 50 times 3,000 is $150,000. We're sitting on $800,000 in cash. We don't want to, or $700,000 in cash. We don't want to deploy the cash, but so we're saying, you know what? If that gets cheap, we'll buy that. Oh, and a week later, and we do it one a week. So we're constantly putting cash in our portfolio. We're promising to buy. And by the time we promise to buy 50 things, then the first thing that we promised to buy expires already. And then we're ready to buy the next. So that's like our pipeline. Oh, so it's not weekly. It's monthly. It's not weekly. Well, it's almost weekly. It's really supposed to be, it's whatever you're comfortable with. Put it that way. I mean, you can do it monthly. But the point is to manage your risk and have a spread of trades that you're working on. And we're dropping 10, 20% of the portfolio by doing that. And we don't have to buy them all. If the whole market collapses all at once, we could take the losses. All right, let's say Gilead dropped 50% to $52, right? Well, we're in for net 76. All right, so let's see. We got 76 minus 52 times 500, $12,000, right? So if Gilead drops 50% and we take the loss, we would lose $12,000. All right, it's not going to bankrupt our portfolio. We're not, although the exposure technically is $40,000 on the position, even in and you're talking about a massive catastrophe, we're going to get hit for $12,000. So let's say we had let's say every other week we did this, and we have 24 positions here. That's $288,000. That's a 30% loss in our portfolio, basically. So if the entire market drops 50% and we take losses on all of these short put positions, we're going to drop $288,000. We're going to drop 30%. But you know what? If we drop from 750 minus 288, so 750 minus 288, 462,000 divided by 750. So we would still have 60% of our buying power left after taking these losses. And don't forget, I'm talking about a real catastrophic situation. But even in that, and again, we also have short positions that would have paid us off in the short-term portfolio, so we'd have a lot more than this. But even in just looking at those positions, we would still have 60% of our money when the market's down 50%. That means we could buy 120% more stuff than we could right now, right? Because all the stocks are on sale at 50%, and we've got 60% of our money. So we're still not in bad shape. I know it feels like bad shape. That's another thing people fail to understand. If you have 80% of your money when the market drops 40%, you're in great shape. You don't need to have 100% of your money when everything is on sale at 40% off. It's kind of like a more advanced way of looking at things, but you have to understand it if you're going to be a good long-term trader, because a lot of these things are stuff, this is what you're playing for. A lot of people, like, if they take a hit like that, when the market drops 50%, you still got 60% of your money in your 401k or something like that, people like curl up into a ball and say, oh, I'm not going to trade anymore, I can't trade, oh my God, I can't trade. That's the worst thing to do. You've got to see the opportunity that's in front of you when you get into a situation like that. All right, so. Boy, I can't take that long answering all these questions. Yeah. Where were we? Yeah, Okay, that was Biotech. Baker Hughes. Update on Baker Hughes. I don't have an update. I mean, I haven't thought about it in a while. Let's see. Baker Hughes. What, are they down again? Is that why you're asking? Yeah, they're right where we want. I mean, they're fine. Baker Hughes is there. And in our long-term portfolio, what the heck do we have? I'll be as surprised as you will. Ouch, 7.6%. We got slammed over here. Hope our puts pay off at some point. Oh, he's holding up okay. Let's see. Baker Hughes. There it is. We have the 50 calls. We sold the 70 calls. And on the whole, this position is not doing that great. But if it liquidates, you have to understand, we're still being charged $20,000. We're being charged $10.20 for the $55 puts, even though Baker Hughes is at $54. If this closed today, these would be $1, not $10.20. And we would be up $18,000 on this position. So, and again, this is something we talk about all the time also. Do not be fooled by the balance on your sheet. If you understand how the options work, this stuff won't bother you. It says we're down 76%, but I would take that. I'll take that trade right now. Are you kidding me? I can sell. Is that even true, though? I don't even know if that's the right price. January 55 Baker Hughes. Let's take a look. That seems like a crazy amount. Baker Hughes. All right. So we go to the 2017 $55 puts. No, see the spread is 615, 1020, so it wouldn't even be that high anyway. They're giving you, this is the thing, your broker's thing gives you the worst possible price. So they're saying if you went to sell this, they're telling you it's 1020. 1020 is the worst. That is the asking price. The bid is 615. We have 20 contracts. There is a $8,000 difference between the bid and the ask. They don't even give you the middle. The last sale was $865. They don't even give you that price. They tell you the worst possible price, $1020. So they make your portfolio look $8,000 worse than it would be otherwise, okay? And that goes the other way too, because for the 70s, oh, I'm sorry, we're looking at the 55s over here. What am I looking at? I'm sorry, I lost track. There's the 55 calls. Yeah, we own the 50 calls. I'm sorry, we own the 50 calls. They're saying they're $825. So the 50 calls are, in fact, $825, the worst possible price. $1160 is a better price for those. Okay? Oh, it was the 55 put, so I wasn't wrong. I was talking about the put. We also have the 70 calls short. They're saying they're $380, when in fact the 70 calls are, look at the spread here, 86 cents, $380. There's a $3 difference between the bid and the ask. That $3 is $6,000. And it's just wiped off your portfolio balance just because they give you the worst possible prices. So this is very silly stuff. Oh my God, and there's 2018s out on this stuff. Oh, I cannot tell you how much I love this thing. Nobody's doing it though. There's nobody actually transacting these. These all say open, but they're not there. I would offer to sell these 2018 5250 puts for $8. I would be thrilled to get $8 for those. So you sell those, and then if Baker Hughes transaction closes, well, your net is $44.50. If you sell these guys for $8, the 5250 puts, your net in is $44.50. Any sale that goes through above $44.50 is profit to you. Your worst case, you get a signed Baker Hughes for $44.50. What do you care? I don't care if the deal doesn't go through. I still want Baker Hughes for $44.50. At some point, we're going to want to drill for oil. It's not dead. It's not going away. I mean, it's going away, frankly, but it's going away over the course of 20 years. It's not going away tomorrow. It's just, I mean, we still, for God's sake, we're still digging coal. Coal is still our primary source of energy in this country. So how are we writing off oil already like it's never going to come back? Of course it's going to come back. It's ridiculous. But this transaction is almost certainly going to close probably in the spring here in 17. So all these things will get wiped out. All your interest will all your premium will get wiped out. So there's nothing wrong with the position. But that being said, I really would want to take a look. If we have the 50 calls now and they're like $10, well, 10.33 was the last. No, they wouldn't make any sense. So I'm sorry. No, I'm wrong. It doesn't make any sense for us to do anything. If we could sell if we can take our 70 short calls here and get an extra buck or two for moving into the 2018 70s, then that would be fine. I wouldn't care about that because when it wipes out, all the premium gets wiped out. But basically, you just have to realize when the transaction closes, all the premium disappears and all these negatives just go away on your balance. So there's nothing to do except for just wait for the damn transaction to close. But that's the key, though. It's like it's not enough to just make trades. You have to understand why you made the trade and how the trade works. Okay? I mean, especially for you guys who are like the new people, or the people coming in from like Seeking Alpha, where we run that portfolio. I hate just having a portfolio where people just watch trades and follow them. You're doing yourself such a disservice, and if you do that, it's that whole give a man a fish, teach a man to fish thing. If you give a man a fish, you feed him for a day, but if you teach a man to fish, you feed him for a lifetime. I don't want you to depend on me or any of these other morons out there who have services that try to tell you what to do. It's ridiculous. I want to teach you what to do. Okay? At PSW, our members, we teach them, and you know what the value is to me of teaching them? Okay, so you say, oh, well, if you teach them too much, they'll go away and they won't be members. No, because we have a group of people who really understand what we're doing, and we have a group of ideas, and everybody has different. We discuss like really good strategies and really smart ways to play the market, and it's so valuable when you learn to how to properly apply these things, and you'll see it unfolding. You'll start seeing the situation unfold. It's just like anything. It's just like any game you learn how to play. It's like you suck when you start, but if you keep at it and you practice, you get pretty good at it, and after a while, you're so good at it that like you can beat almost anybody else who comes to play. That's all this is. It's a matter of practice and learning and sticking to it. But you're never going to learn anything if all you do is just buy a position and then look at the balance to see if you're making money. If you don't understand why you're making money, why you're in the position, how the balances work, you're just going to be at the mercy of like any idiot who just wants to tell you they have good trades. And it's not a good way to go. Believe me, you're going to be trading your whole life. Anybody who's trading now, it's very unlikely you're going to stop trading because once you discover it, you're like, oh, this is a great thing to do. But it's only a great thing to do if you learn how to do it properly. Otherwise, it's a very frustrating thing to do. So take the time. And I've talked about this before. Malcolm Gladwell did a study, and I find it realistic. There's people who say no, yes, whatever, but the bottom line is I find it a realistic number. He says it takes you about 10,000 hours of practice to become an expert at anything. So 10,000 hours of practice is 5 hours a day for 5 years. Is that right? 5 hours times 200. We would say 200 days, 5 days is 1,000 hours. Sorry. It'd be 5 hours a day for 10 years. Assume you don't practice every single day, but like 200 days a year. Kind of like school, right? So it's basically like going to school. Now, we kind of know that's true, though, because in order to become what an expert means, a functional expert means as good as you're going to get to a level where you can pass yourself off as being very well versed at something. You know that's true in your job. You do it 8 hours a day for 5 years, and you get to be pretty good at it, right? You know that's true in school. You send the kids to school for 5 hours a day for 10 years, and they get pretty good at it. They get good enough to go to college. All right? The same thing with instruments, same thing with football. Football, you practice 5-6 hours a day for 10 years, and you're varsity, and those are the guys who get to go to high school and whatever and get to play college football. But you have to dedicate yourself. And most people in their lives, they usually, often it's unfortunately just a hobby that doesn't pay you any money, but most people in life, they'll find a few things that they love to do that they get really, really good at by accident, but because they do it over and over and over again, get better at it. Even if it's reading, you get really good at reading. My kids are already, like, they put in their 10,000 hours on texting. My daughter, when I'm in the car, I talk into my phone to text to people, and my daughter gets so frustrated because it takes me like 5 times longer to talk into my phone and have Siri translate my speaking to text than it does for her to type it. So now whenever we're in the car, she just sits there, even if she can be on her other phone doing stuff, and she'll still take my phone in her other hand, and she can text as fast as I can talk. So it's an interesting thing, although Siri's getting actually very, very good with the speech recognition. But point being, though, here she is. She's 13 years old, and she's already one of the world's fastest texters. And she can do it with 2 hands at once. So it's just a matter of practicing. I don't know quite what the skill set's going to be, other than she could be probably a good secretary. But, the trick is to find something that's going to be good for you to practice for 10,000 hours. And if you're sitting here listening to this webinar, you're probably the kind of person who likes to trade. And if you like to trade, take it seriously. See, unfortunately, a lot of people say they like to trade or they want to be traders, but their idea of being a trader is chasing after some guy and paying him to give him some ideas. They don't, you're not sitting there saying, I want to learn how to trade. I want to learn and understand options. No, just give me some trades that make money. And you can do that, and your only skill then becomes, I'm good at paying people to tell me what to do. That's your skill. That's the only skill you're developing. It's like, I'm going to pay people to tell me what to do. The skill you need to develop is, I understand how to trade, and I can make a lot of money trading because I understand what this guy is telling me and how he's telling me to do it, and I can even go find my own trades. That's when you're going to start making some real money. So, there's my commercial to to not use services like mine. But honestly, most of them suck, and I do my best to try to actually teach people, but it doesn't do any good if you don't want to learn. So I really would like that attitude with the people, the guys in the option opportunities portfolio especially. Please ask questions. Let's learn what we're doing. Let's not just, take things for granted. It's a process, and it's a process that's going to take years to go through. All right. Robert says, incompetence of other people's money, CEO is an a-hole, not doing his job as usual, and golden parachute. I guess we're talking about Volkswagen. All right. Chinese premier should boost BA when he talks in Seattle, the big jet deal. Yeah, well, I like Boeing. I love Boeing long term. Have they gotten cheap enough to buy? BA. No, not really. I would have loved them if they'd stayed at 115. I would have totally been all over them. But I'm not in love with them at 130. Look, but again, it goes back to that same thing. This is the simplest trade I will ever teach you how to do. Is you say, well, I like Boeing. I like it for 115. If I go to 2000, these are only 2017, 2018's aren't out yet. If I promise to buy Boeing for $115 in 2017, someone will pay me $9. See, $885, $905. Somebody will pay me $9 to promise to buy Boeing for $115. That's going to net me in at 106. It's at 132 now. All right, that's $26 off. That's about a 25, it's almost a 25% discount on Boeing. Actually, it's a 20% discount. It's easy math. So there's how you can buy Boeing for 20% off. And that's just what I was talking about, I think, this morning when I mentioned that how to buy stocks for a discount. That's not hard. Why would you pay retail if you can do that? Someone's going to hand you $9,000 cash in exchange for your promise to buy Boeing for $115. 1,000 shares, but I'm saying. But still, you're not actually buying it. All you're doing is this. You say, I'm going to sell a put. These are puts, so that's why when I say sell, it knows what I mean. Single sell 10 BA puts, 2017 115 puts, $9, and I send it, and it tells me I'm going to collect $9,000, and it's going to use, again, margin efficient. It's going to use $8,000 of margin. All right. Now with Boeing, though, see, Boeing. This is another thing, by the way. This is where it is worth paying me, because these are things I'll always tell you that are very important to know about each individual stock. The thing about Boeing, it's not like AT&T, it's not like GE or something like that. With Boeing, they've got one product really. They've got planes. They have different planes, but they have planes. They got drones, they got little, I mean, you could argue they have other stuff, but the bottom line is they're a plane company. If a plane falls out of the sky while you're sleeping, and it looks like it was Boeing's fault, even if it's not Boeing's fault, if it's not their fault, they'll be down 10% at least in the morning. If it is their fault, they'll be down 20% in no time. So all of a sudden, your $115 puts are on the money. And how much are the on the money puts? The 130 something puts are $14, and the 135 is $17. So call it $15. So basically, you would lose 100% on a plane catastrophe before you could do anything about it. Now, that being said, I still don't mind owning Boeing at that price because, frankly, if I can withstand a 20% drop, if a catastrophe strikes, or the market drops 20%, they'll drop with the market too. But I'm more concerned with Boeing about the sudden catastrophe. So you have to be prepared to say, I can afford to take that loss. And you have to realize that if you get to there, your margin will go up considerably. Like, let's take a look at the 135 puts. Okay, so let's say Boeing dropped $20. Then you're going to be selling these puts. You will have still sold them. You wouldn't have sold them for that. You would have sold them for $10, right? So, 10. So you still sold them for 10. Doesn't matter if they're 17 at the time. So you sold them for 10. And you have, well, even in the buying power is not so bad. You have 12,000 buying power. So, I mean margin. Sorry, your margin is 12,000. But so your margin, in other words, your margin would shoot up on you. Not terribly though. It went from 8 to 12, so 50% increase in margin. But you will be down $8,000. And so unless you can grit your teeth and ride that out, and understand though, if you're on the money, if Boeing's at 115, you haven't really lost anything. It just is going to show a loss until time fixes it. My attitude though, absolutely. First of all, so I'm going to say I like this trade a lot. If you sell these 115s for 9, hell, you can sell the 100s for 5 too. I mean, I would do that. But if you sell the 115s for 9, when 2018 comes out, you'll probably be able to sell the 105s at least for the same 9. Okay, so first of all, you can roll and pick up another $10. You can go another 10% off almost on a roll. Second of all, if you buy a reasonable amount now, like an amount you can easily afford and you don't mind doubling down, if you buy a reasonable amount now, then even if it does drop like crazy on you, you can roll out to 2 times the 2018s and have a very reasonable position, maybe all the way down at like 90 or something like that. And if you don't want to buy Boeing for 90, if you don't really want to own Boeing for $90, why on earth would you even be looking at it 132? Okay, now that's why I said though when it did fall to 115. That's like the Candyman showing up. I mean, you could have gotten all kinds of great pricing. If you look at this channel right now, they're kind of weak, and I don't think I really want to dive on them right this minute, even though I said I like that. I love those puts, but I love them more when they're $12 if this thing drops a bit more. So hopefully, Boeing, right now Boeing's being held up by this little weird line, which is God knows what. It's one of those moving averages. It's a 20-something moving average. So this little line here is curving up because it was pulled up by this spike up here, but that's just a spike up. I would ignore that. And right now, that's where the support is, exactly at that spot. If this support breaks, then they're going to go down pretty fast back to this test line around 125. That's when you want to pull the trigger if you want to get into it. You know, so I love Boeing, and frankly, whenever there's a disaster, I jump on Boeing. You know, whenever there's something bad happens, I want to buy. I always look to see. But that's even when you ask that question, like, oh, what are they at? Because I get excited to buy them when they're cheap. But only then, because otherwise they're going to get cheap. The history of Boeing is they constantly drop off for whatever reason and get cheap. Why does this keep repositioning? Okay. I should be looking at these future counts. Nothing. Any attention in case anything's happening. Nothing's happening. No problem. Okay. Oh, I said we were going to do a bigger picture, though. Before I do any questions, let's do the bigger picture. So this is FinViz, F-I-N-V-I-Z, and they've got charts of the futures. Let's go to their home screen. I'll show you how it works. Here's their home screen. This is kind of fun. I like this overview. It shows you it shows you the major sectors and all the stocks in the sectors, and you can see what they call a heat map. Well, in this case, there's no heat. This is more like a deep space cold map. It's incredibly horrible. There's some life in the utilities, which is normal when things are selling off. There's a couple of little things in the industrials, and otherwise dead, though. I mean, generally just dead. Just go right here to futures, though, and you get this map of the futures, which is sort of helpful, not helpful, but it's all right. It's cool because you can do this, but I just prefer to just go to the indexes and look at the charts. And I especially love these, though, because you can go from 5 minutes to hourly to daily to weekly to monthly. So it gives you like all kinds of views. So if you look at monthly, we'll start there. Look in the grand scheme of things. This is nothing. There's a little pullback. We've had little pullbacks before. This is nothing. Up, 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 and a little pullback. Okay, we had up, 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 and a little pullback, and up, 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 and a little pullback, up, 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 little teeny pullback, and then up, and now it's a better pullback. All this is a pullback, though. There's nothing devastating, nothing horrible going on here. DAX, though, and this is, but you could probably blame Volkswagen for some of this, but DAX did not hold their 10,000 line, and they're breaking a long-term trend. These are months, don't forget. We're going back to 2012. That's a long-term broken trend. And if this line fails at 9,000, they could go right back down to 8,000 so easily, and that would be horrible. What I think is going to happen, though, even so, I think we're going to weekly bounce off of 9,000. I think we're going to dribble around here, sort of the mirror of this, and then you're still going to have a big inflection point. This is going to come a long time from now, though, like sometime next year. I don't see anything that's going to really propel us back up, but of course, Draghi speaks next week, not next week, Thursday. Is it Thursday? Yeah, Thursday morning, I think. Draghi's speaking Thursday morning, and he could say something that could lift us back up, and then Yellen's speaking Thursday night, and she could say something that could lift us back up. So this is not set in stone yet. It looks bad because you're looking at the monthly chart, but in the daily chart, see, we only just went down for 2 days. If we go back up, even on the weekly chart, you won't even see this happening. You'll just see one of these little lines like that. That's what this will look like. It will look like this line. See, and again, this goes back to the same as the options. Okay, if you're going to look at charts, you have to understand how charts are drawn and why they're drawn and why they look like that. Not just looking at a chart. Why did that candle end up being drawn that way? Why did this line move that way? If you understand that, you'll see charts at a whole different level. You know, you can't just look at the picture. You have to understand how the picture is being drawn and how it will be drawn tomorrow if different things happen. That's going to help you understand these things much, much better. Anyway, so back to the grand scheme. So in the grand scheme of things, these are just minor pullbacks. In the weekly view, okay, we pretty much lost our entire year's everything. You know, I mean, here, you know, we're negative for the year. 1750 to 1600 is 10%. This Dow's down 10% for the year here. 2100 to 9 is 1100. That's only about 5% on the S&P. The NASDAQ started the year off rough, so we're right back to zero on the NASDAQ. The Russell started rough. We're at zero on the Russell, just going a bit negative here. The Nikkei started here. We're back at zero on the Nikkei. And the DAX is here, and we're actually zero on the DAX. So nobody's really that bad, except the Dow is. Now, I guess you could argue, though, the Dow never should have been up here in the first place. That's the easier way to put it, but that's true of the S&P too. This rally was nonsense. It reversed itself, and so the year should have really opened in this area up here. But either way, the Dow's down pretty severely, and that's including Apple. Don't forget, Apple's still having a good year. But it's not helping. It's not enough to help the Dow because those components are selling off. Why are the Dow components selling off? Because they get most of their revenue, or at least half their revenue, from overseas, and overseas sucks. Why is the S&P selling off? Most of their revenue is from overseas, okay? Why is the Russell holding on? Because they're local. These are small cap companies. They don't do a lot. They do 70% of their business in the USA. The USA is doing better than all the other guys. So if you pick companies that are based in the United States and are doing business in the United States and don't service the masses so much, that's the other trick. Stay away from the people. You know, it's okay if you sell a hamburger. Not that the hamburgers are doing well right now, but it's too much competition. That's why. If you sell a hamburger, though, everybody buys a hamburger, so it's a matter of choosing which hamburger, right? But if you sell discretionary items like movie tickets, it's hard to sell a movie ticket that costs $15 to people who are trying to figure out where their next meal is coming from. Okay, that meal is going to be a hamburger. They're going to go somewhere for a hamburger, but they don't have to go to the movie. All right, so Kraft will do well. Campbell's Soup will do well. Procter & Gamble will do well because you got to buy this stuff. Okay, but you know, no matter how poor you make people, they might buy a little bit less, but they're not going to buy none. So you're servicing the local population. But when you start talking about discretionary items, you know, if you're trying to sell bicycles, if you're trying to sell snowmobiles, if you're trying to sell camping equipment, you got problems. Because that's not for the elites, that's for the regular people, and you're saying, well, do you guys have any extra money? You know, Nike's going to have that problem too, trying to sell $200 sneakers. I don't know, you know, these prices have gone insane in the first place, and now they're going to see if they have enough rich people to cover them. On the other hand, if you sell to the top 10% and you don't and you're not overly ambitious about it, like Tesla, just to sell cars to very rich people, like Lululemon, they're not trying to sell as many jeans as the Gap sells. They're trying to sell $150 yoga pants to rich people. And there's plenty of rich people. The top, you know, it's funny because you talk about the top 1% all the time, but you have to think in terms of how many people are in the top 1%. Well, there's 1 million. There's 300 million people in this country. The top 1% of this country is 3 million people. That's a lot of people. That's a lot of yoga pants. So, you know, you can make good money selling things to rich people. Okay? And you can make money selling necessities to poor people. But if you're not doing one of those two things, there's a big problem area in the economy. Because we really destroyed middle-class discretionary income. And that's something I talked about a lot last week, because I talked about it because I'm trying to explain to people why we're in cash. Because it's a very dangerous time for the market. Oh, wait, let's go back to that. Sorry, I didn't finish that. So here's your daily view. And see how it looks. See how the picture changes. See, if you're monthly, you're like, this is nothing. Then you go to daily, and you're like, oh, my God, it's a catastrophe. And you got hourly, and it's like, we're dying. You know, you look at the 5-minute chart, also, you're dying. You have to get your head out of these short-term charts sometimes, even the dailies, and get a bigger picture. And the bigger picture tells us that we have broken this uptrend. All these uptrends are broken. And now we're going to see if we're going to really break down. So here's see here, Russell. This line on the Russell, which is 12,000, which is our must-hold line. And there's a reason it's our must-hold line, because it better hold, right? So, I'm sorry, this is 1,100. It's 11, what is our must-hold line on the Russell? I think it was 12,000, actually. I'm sorry, 12,000 on the Russell. This is a 10% line, 1080 on the Russell. But that stuff has to hold. Otherwise, you're doomed. Otherwise, you're heading into a really deep, dark place. This whole thing starts rolling over. And how do we know that? Because we know all these moving averages are rolling over. This has been going on for, what is this, 2015? That must be June. So this has been going on since June. That's a lot of days. Those are weeks. These are the days. So when you talk about the 50-day moving average and you think about the effect of it, here's 20 days, 40 days, 60 days, 65 days. So that means your 50-day moving average, which was here, would average between here and here now. It'll come all the way down to here. That's a big move in the 50-day moving average. And that means if you look at the chart, you're going to see, where is it? Not that one, this one. Was that the Russell we were looking at? So if you look at the chart, you're going to expect to see the 50-day moving average curling down. And where is it? See? That's exactly what we expect to see based on that action. It's been curling down. And where is it curling down to? It's down to 1195. Well, it says so over here, 1195. Thank you. All right. So did I predict 1195 based on that? Well, between here and here is here, 1195. So you see, I don't need the squiggly lines to tell me where my 50-day moving average is. I understand how a 50-day moving average is drawn. And because I understand that, I know the effect of going further down is going to pull that 50-day further down, and it's going to make it a sharper line down, and then it's going to be harder because now the 50-day moving average is under our must-hold line. That means you can't even get over our must-hold line anymore without breaking the 50-day moving average, which is pushing down with quite a bit of force. It's heading down, and it's going to smack you when you try to get back over it, just like yesterday I was talking about how the NASDAQ was going to get smacked if it tries to get back up here. Okay, exactly like that, because the downward moving averages, when the 50 and the 200 especially, become formidable to break over when they start moving down on you. And the sharper they're moving down, the more they're going to smack you when you hit them. It's just like physics. It's just like a ball hitting a paddle in physics or something like that. So you can see how it gets worse and worse. And you can tell what the effect is going to be. And look at these things. These are wiping out. This is the hourly chart. They are wiping out. And this is not good. Look, we're down to 2.5 here, 2.28. Don't forget 2.5% is where we expect to bounce. So 42.30 on the NASDAQ futures should be bouncy. And if they're not bouncy, if they don't move up at least 0.5%, that would be a weak bounce, right? Again, 5% rule is very easy, right? If you have a 2.5% intraday drop, then you should expect a 0.5% bounce if the 2.5% line is destined to hold. That would be a weak bounce. If we don't get a weak bounce intraday of 20% of the drop, 20% of 2.5% is 0.5%. So if we don't get a weak bounce intraday, then this move is almost certain to keep going down. So that's a very easy way to look at the 5% rule. If you get a 2.5% move down and you finish lower than 2% for the day, so if you touch the 2.5% line and you don't make it back over the 2% line, then the chances are all you're doing down here is consolidating for a move down. And the funny thing is, I'm saying this now. I want you guys, if you're listening to this on tape later, I want you to look at these charts and look at exactly what I'm saying. And when you look at your 5-minute chart or your hourly chart a day or two from now, you will see, well, you'll see this. Basically, you'll see this action. This is consolidating, but it's not consolidating. It has to go back up. It has to go back up how much? 20%. 20% is 20 points. It has to go from 42.30 to 42.50. It already tried to do that. Here's the 2.5% move down. Here's the exact weak bounce. That is predicted by the 5% rule. I knew that when it hit here. I could have told you what we're going to test. We test 42.50 because we went 2.5% down. Chances are you're going to see a weak bounce. So we got a less than weak bounce here. Then we made a second attempt at a weak bounce. And you know what? Another rule, which isn't, I'm going to write these down, but the rule of thumb, if you, on the second bounce off a low like that, off 2.5%, on the second bounce, if you then fail, the third time you're going to fall through. And then you want to see how far you fall through. How far are we going to fall through? Well, those of you who follow us know how far you're going to fall through. You're going to have a 10% of the drop or 20% overshoot before you come back to test it again. What do we have? We had a 10% exactly, another 10-point overshoot, and now we're coming back up. But now you're going to chart off of this line. 20 points off of here is 40. If we fail at 40, it means you're just trending down. If we go back up to 50, it still doesn't mean anything until we get over 50. And that's what we're intraday, so about by the end of today. We're not going to get to 50 by the end of the day. We may test 40, but if we fail at 40, down we're going. We're going to finish the day in this range, and then tomorrow we're going to go another probably 1.25% lower than we are now. That's it. It's so easy to calculate this. It's based on the 5% rule, and I'm not going to get into all that today. But it's a simple thing. We can calculate these things all day long and tell you exactly what's going to happen down the road. And that tends to be useful when you're playing the market. All right, what else? Do another question. Why do you not like Boeing here? No, I didn't say that. Oh, God. I wish there was a better way this Q&A stuff worked. All right. Okay. CK says, when you're doing fundamental analysis, How do you determine the right PE to start a position? Don't want to pay peak earnings. How do you determine the right PE? Well, that's a hard question. I mean, all right, first of all, as a rule of thumb, I don't want to pay more than 20 times earnings for a stock. Then it gets modified. Do they have a lot of growth? Do they have good prospects going forward? Are they doing something exciting? Are they trading much lower than the rest of the sector? But as a rule of thumb, for me, I like to get I like stocks with PE of 20. There's 9,000 stocks out there. There's probably about 1,000 or so that have a PE of less than 20. Now, of course, there's dividends are a factor. There's and the quality of the earnings, of course. You can't ever go by the 1-year PE. You've got to look back 5 years and say, is this really their earnings? PE can be anything because they could have done some weird thing some weird thing with their books last year or this year, and it makes their PE look all wacky. In fact, that's another reason sometimes you want to look at stocks. Sometimes a stock has a PE of 100 because they did something this year. They did a write-off, like Hovnanian, for example. Hovnanian last year, their PE was 1,000. I mean, they took losses last year. They had terrible PE. This year, their PE is 3. 3 is pretty good. Still, everybody's just terrified of them because it goes up and down like crazy, and you never know where they're going to stand. But I just like to own the stocks because one day maybe they'll do well. They have the potential to earn $1 billion in a year, and I can buy the stock for $200 million. I can buy the company for $200 million, and sometimes they earn $1 billion. I'll hang out for the sometimes. I'm not really worried about whether or not they make money during any individual year, as long as they don't go bankrupt. If they can manage not to go bankrupt, I think in the next 5 years they'll hit one good one, and I'll get all my money back. So it all depends on the stock, and you can't ever use any one thing as a rule. I mean, that's the thing. Because if you do a screener and you look for stocks with lower than 20 PEs, you'll miss some bargains because some people are putting money into R&D and some people are doing other things. And also you'll be misled because sometimes the PE looks low because of some accounting shenanigans, and next year it won't be anything like that. So you got to really be careful about the quality of your earnings and look at the stock from a long-term perspective. You want to see steady movement, steady growth in earnings, consistent sales, and you want to also obviously investigate the company looking ahead. I'm not a screener person at all. I look at companies. Generally, the way I'll end up in a stock is I'll start off with a sector story. I'll think something based on the global economy. I'll think something's going to do well. We like commodities because I think we're at the bottom of a commodity cycle, so we kind of like commodities, even though it's going to be a long and painful process, but it's a nice time to accumulate certain commodity plays. The ones that survive are going to do great. The ones that go bankrupt will go bankrupt. End of story. But long term, I think there's going to be inflation. Like we just picked up some gold last week, so I like gold when it got to $1,100. There's certain things I like long term. So then once I say, oh, I like gold, then I start looking at different miners. And I say, well, okay, if I like gold, I probably like some miners. Let's take a look at the miners, find the least objectionable one, which for me is ABX, Barrick Gold. Gold Corp is not bad either. And then we look to see if they have good options, if they're in a good position, if I can get a good value, if I can get a good discount for entering them. All that comes into play. Because again, it goes the same thing. Look at Boeing. But I don't care about the PE of Boeing as it stands now. I mean, it's a guideline, but I'm going to buy it. I'm not going to buy it for $140. I'm going to buy it for $110. I'm going to discount $104. I think it worked out. We're going to buy Boeing for $104. I'm going to buy Gilead for $80 or $74. I'm not going to pay that PE. It's a good starting point, but it matters more to me if I have good options to sell and what kind of discount I can give myself. So I'm not going to buy that stock straight up. Ken says, using Thinkorswim, what drawings are you using for the bands on the futures? Okay, the drawing on Thinkorswim, I don't know why it gets asked every week. It's like nobody ever... Every week we have the same question. These are called pivot points. And if you go to studies, and it says add a study, and you go to trend studies, and then you go to P, I know it's annoying, and then way down there is pivot points. That's it. And I use all the standard measurements. And the reason I always use standard measurements is because I don't I just like to look at the lines to get an idea of where people think things are going to turn. I know where they're going to turn because of my 5% rule. I'm a lot better off with my 5%. In fact, look, see how wrong they are? We were just talking about how exact the 5% rule was when we were looking at what, the Russell? Yeah. The Russell pinged the 5% rule exactly to what it's doing now, yet this thing is off by a mile. Okay, so I don't go by these other than this is where other people are watching. So why would I change it? I mean, they let you customize all these things. I'm like, why would I change it? I want to know what everybody else is looking at. I don't want to change it. If I customize it, then I'm not seeing what the crowd's doing. I want to see what the crowd is doing. So I always leave my settings exactly as default because I assume that's what most people roughly have. And some people think they're smart and go one way. Some people think they're smart and go other ways. It averages out anyway. Which is also one of the things the 5% rule takes into account, that people are idiots and they think they're being smart, but they end up just doing the same thing as everybody else. Let's see. Okay. Surinder says oil in a 44.50-46 range, and yours is more likely to break down a little bit. Yeah, we think oil, well, today or tomorrow, oh no, today, for sure today is the last day trading that oil contract. So let's take a look at that here. So look at oil and Brent. So here's hourly, a little more useful. So today, I believe is, well, let's just see trading today. I'm going to tell you in a second. I'm going to look it up somewhere else. CLV5. Yeah, CLV5 is still trading today. It's closing in 30 minutes. So in fact, I could actually tell you right now that probably oil is going to sell off a bit into the close. So CLV5 is at 45.50. CLX5 is the current contract. It's 45.78. So today's the last day for the September contract to trade, and now we're moving into October, which is CLX5. Whenever the contracts close, as you get closer and closer to the contract expiration date, people have to get out of the front month contract, and it puts downward pressure on the prices, especially when the barrels are backed up, and they were very, very backed up when we looked at them last week. On the NYMEX now, I got to look over another computer. On the NYMEX now, there's only 17,000 open contracts left as of the morning. There were like 150,000 last week, so they dumped 130,000 out of 150,000 contracts, and they put them into November because November already has. I'm sorry, I said September before. October is the expiring month. CLV5, CLX5 is November. November has 458,000 open contracts. And bear in mind, today is the last day of October. They have 17,000 in the morning. They'll have like 5,000 by the time they're done. So in November, out of 458,000 contracts that are currently showing open, 450,000 of them are fake. Nobody really wants that delivery. It's a complete sham. That's what oil trading is. It's an absolute total con, with people trading fake orders back and forth all day and all night long. In fact, the turnover today on the NYMEX, 246,000 contracts. Another 60 is 300. I see 350,000 contracts traded. That's in one day. 350,000 contracts have been traded, and only 5,000 will actually be delivered at the end of the month. And in one day, they trade 350,000 contracts. It's a complete farce. There is nothing real about anything that goes on with oil here as trading. It's just a complete manipulated sham of a market. That's how it works. Meanwhile, that makes it fantastic to make money on, because we can look at these things and figure out how they're going to be trading. And since we know it's a scam, and we treat it like it's a scam, we have a very easy time picking out what they're going to do. So today, coming into 235, there's going to be pressure to push this contract down a bit, possibly a bit below the 45.50 line. But then, over the course of the next week, and it may go a little bit lower, still, we may get a little bit lower over the next few days, because there's nothing to put pressure on it. But then, as of Thursday, what's today? Wednesday, Tuesday or Wednesday? Tuesday. As of Thursday, hopefully oil will be around 45, maybe 44.50. I would want to go long into the weekend because then we're into the period where they don't have a lot of pressure to close their contracts, and that means they can manipulate it higher. Okay, so that's the best time to start going long on oil. And here you can see earlier this month, we had a little, ran down in the 44.50 range, and they pushed and pushed and pushed. But then here, this is their last hurrah. They did the big push here, did whatever they could to get it up to a higher number, and then the big fail, and now we're back to here. The real price is still 45. Barring any change in OPEC or anything like that, 45 is still about the right price for oil. But it could easily go lower now because of the winter doldrums. So the only thing keeping it supported is everybody thinks OPEC is going to somehow cut back or do something and help. Or there's also now talk that these U.S. shale producers are going to go bankrupt, and that'll curtail supply somewhat. So that's what's holding oil up. It's just the hopes that something horrible is going to happen somewhere. If not for that hope, if everything was fine and nobody's worried about that kind of stuff, then oil would be in the 30s. But meanwhile, those things are real. You take them into account, and that means probably 44 is going to be a good floor right now. And again, I said, I don't think I want to take a chance right now, but by Thursday, I think we'll probably be down around 45, maybe 44.50, and that's when it could be a good time to go long. But again, it depends on the news, depends on the situation. So you just got to wait and see. But as of right now, I wouldn't touch it. In fact, we kept drawing this chart. Oh God, I don't think I'll be able to find that. Anyway, I had this chart where I was showing the lines for oil, and wait, what did I just do? Oh. I had the lines for oil, and basically they were drawn, but the point being that they're drawn down here at 42.50, and I forget what the other one was, but basically, in other words, here's where we go long, down here. Here's where we go short, up at $50, and here in the middle, we don't do anything. Oh, I know it is. It's 47.50 and 42.50. That's what it was. So at 47.50, we like to short. That we know. That's a good shorting line. And you can see it right here. See how that works? 47.50 is a good shorting line. In fact, I'll go to daily, and you'll see it also along this trend. So for the last month or so, we've known that. And our long is at 42.50. And even here, we spike below it. But 42.50 is a good place to go long. 47.50 is a good place to go short. And in between, we don't care. And this is a mistake people make also. This goes to anything, though, any stock. You got to look at a view like that and say, why would you trade the middle of the channel? It could go up or down $2.50, very easily. There's nothing you could possibly do to say, I know which way it's going to go when it's between 46 and 45.50. It could randomly do anything. You take the broad lines and you wait for those bets. And I pointed this out also. You can do this and that, right? Take this, and even if you're like 60% accurate in your betting, you're only going to squeeze out a few bucks here and there, right? And you're constantly going to be in tension. Instead, I'd rather wait. And when it really comes down, then I'll go long. And when it really goes up, then I'll go short. And I have a nice relaxing time, and I make more money in this one move down or in this one move up than you can make doing this 100 times. And it's so much more relaxing. We had a huge winner last week, didn't we? I forget what we were playing. We were playing something. We made a gigantic amount of money last week. That's all. Patience, especially for futures traders and day traders, it's so hard to just be patient and wait for a good spot. But that's really what it's all about. It's like if you can learn to do that, you'll become a really successful trader. But the problem is a really successful trader doesn't trade 90% of the time. 90% of the time, you're going to look at this and go, nah, not a good setup, so I'm going to walk away and do something else. I think a lot of day traders, the most important thing they can do to improve their day trading is get a hobby. Because if your hobby is sitting there and staring at a screen all day, you're going to trade too much because it's really boring. And so you end up trading when you probably shouldn't. Jerry says, based on your expert discussion for learning to trade, what is the key to identifying the correct time to enter a CL trade for either buy? No, again, the correct is when you get a really good line, very strong support, not the 5-minute support, but the hourly, the daily support lines. When you get a serious support line, that's one thing. Second of all, it's not a line. I'm not a technical guy at all. I know the technical line is there. I'm not ignoring it. There is a technical line, so we use it for a guideline. But when it hits a technical line and the dollar is getting weaker and I haven't heard anything from OPEC and it's a certain position in the week and there's not too many contracts on the NYMEX, all these things are factors. And when all those factors line up, then we make a trade. But 9 out of 10 times, we don't make a trade. So the key to identifying the correct time to enter the trade is not to enter the trade most of the time. And you do it when you're damn well sure, when you're going to be shocked if it doesn't do what you think. And that's another thing, is you have to pick and my favorite places to enter are the places where I say, you know what, this is such a strong line of support, like 47.50 or something like that. I would say, here you go, like if I'm short at 47.50, I'm like, this is such a strong line of support that if I'm wrong over 48, I'm going to get out with a small loss. It's not a small loss, it's $500 a contract. But I'm going to say here, it's like I'm going to go short here with a bit of conviction. And I'm going to ride this up, and if it goes to 48, maybe I'll double down and be short at 47.75 for 2. But I'm going to short with conviction here because I really, really think this is going to stop. And when I'm down here at 44.50 or 44 especially, I would say, in fact, well, again, the daily view is a little too long. It's hard to tell. So you look here and you say, look, at 44.50 has been a pretty good, consistently long place. So again, the same thing with a very, very small margin for error. I'm going to take this position. And by the way, you also save yourself a lot of heartache if you don't short at the line like this. You short when you're crossing below the line. And then you set your stop at the line so you can't lose money. So in other words, I'm going to short at 47.50. I don't short when it's going above 47.50. I short after it's done going above and then it starts coming down. Then I grab the short. So then I'm short here, probably get stopped out. I'll short again on the next breakdown. I get a nice run here. I stop out. I get over again. I wait. I short again. It goes down. I stop out. Goes up again. I short again. And now I'm in for the ride because it doesn't stop me out. And now I'm down, down, down. And then it's just a matter of how greedy you are, basically, as you keep going. And again, once you make all this money, once you make some nice money here, then I can have a little bit more leeway, and maybe I'll stop out here, and then I'll get back in here at the 50 line. Then this 50 line, I'll take it off, and then I wait for the bounce, and I get in again at the 50 line. That's how we play it, in and out. It's easy to make quick money in and out and get off the table rather than try to make one great big giant amount. And yes, sometimes we miss a move like this. Sometimes you're not in time. You don't get it. So what? I'd rather be consistently winning and have a 60-70% winning ratio and make $500. Again, you got to realize that if you are 60%, then you're going to make $500 6 times. It's $3,000, and you're going to lose $500 4 times, which is $2,000. So that's a $1,000 profit. So if I'm consistent with my amounts, and I'm consistent with my stops, and I'm consistent pulling in and out of positions, if I can run 10 positions and get in and out 10 times for $500 gains up and down, 500 gains, 500 losses, all I have to do is be 60% effective, and I'm going to come out way ahead. If I'm 70% effective, then I have 3,500 to 50, and I double it. Then I have $2,000 profit on the same 10 trades. Now, knowing that's how I trade, then what does that make you think? Well, then obviously if I'm in any trade and I make a quick $200, I should get out. Or I should at least look to lock those profits in. Because you know what? $200 is my average profit. And understanding the way you trade and understanding that about yourself, you say, you know what? To make $200, to not take my $200 and run when I make it quickly, I'm not working for it. Just like let's trade there and make a quick $200, which you guys see me do all the time here in the futures. You take it off the table because really $200 is the same amount of money I would make if I was 70% successful on 10 trades. I would make $200 per trade. So I can't expect to do much better than that. That's really about as good as I'm likely to do as far as taking trades, as far as taking my spots. So even though you end up making $2,000 on 10 trades because you're using $500 blocks, the reality is you're averaging $200. So you have to learn the value of $200, especially when you do it quickly, because in the future you can do that in 5 minutes. So if you do it in 5 minutes, why be greedy? Why wait for more? It's going to bring your average up. Understanding that is going to make you a much better short-term trader. You have to understand how, you have to run statistics on yourself. And you have to understand your statistics. It's funny because I know people who, I know a lot of guys who they trade and they never do that kind of thing. Yet if you ask them about if you ask them about baseball, they can tell you all the statistics and why this guy should be put in this situation and why he's a better batter against left-handed pitchers and so on and so forth. Yet you don't think about why that should apply to your trading. Your trading is just as important. I'm successful 75% of the time when I short at 47.50. I'm successful 50% of the time or 60% of the time at 44.50 going long. Therefore, these statistically are the best places for me to go long and short. In here, 50-50. I don't want to play when it's 50-50. I want to play when when the odds are like 66%, 70% in my favor. That's when I want to make my entries. And it doesn't just go for the futures, it goes to everything. I want to have a 2-to-1 advantage when I make my options trades. I want to set up spreads that pay me twice as much as I can lose. Because if you're going to make twice as much as you can lose, then I only have to be right about 40% of the time. I don't even have to be right half the time. So I make twice as much when I win as when I lose. So if I'm right 40% of the time, making twice as much money, that means 4 times 2 is 8, minus 6 losses of 1 is 6, and I'm still up 20%. Because I want to take good risk-reward ratios every time I play. In the futures, your risk-reward is equal 50-50. You go up or down, you're going to make or lose the exact same amount. So in that case, I can't play that. I'm not getting a better risk-reward ratio, so I damn well better pick my good spots. But in options, I do both. I try to pick a good spot, and I try to pick a good spot for the stock entry, and I try to pick a good risk-reward ratio on the options. And if I have both of those things going for me, I end up with a lot of confidence on the trade. It's not really complicated. I mean, it's just a matter of doing it. It's a matter of thinking it through and doing it that way. All right. Okay, where are we? So that was oil. 5% we talked about. Why do you not like Boeing? No, I do like Boeing. I just don't. The only thing I don't like about Boeing is that it's turbulent. Same with Volkswagen. Sell or put there after the dust is settled. Yes. Okay. Dita, I agree with that concept. You're in Germany, I imagine, so you're selling Volkswagen puts. I don't think I would go now. It's kind of like BP. The number that's been floated so far is $7 billion. They put aside, that's nothing. It's going to be $20 billion. And they're a $60 billion company. It's going to be a huge hit. I don't know where they dropped to the bottom line. Let me take a look. Hang on. Volkswagen. Oh, where were they? Hang on. It's not a normal U.S. stock, so we don't know. So they have a $60 billion market cap after the drop, of course. Oh, there you go. They do $250 billion a year in sales. It's pretty massive. And they drop $13 billion to the bottom line. All right? Now, BP, by comparison, seriously? BP, by comparison, $353 billion in sales, and they dropped about the same. So basically, they're about the same as BP. So if you really want to get an idea of what's going to happen to Volkswagen, I would say the scope, and this is just rough, of course, but I'm going to use Yahoo again. It's going to start giving me commercials. Remember last week we had a couple of interruptions for commercials on Yahoo. BP had their crisis, I forget when. It's on this chart. Let's see. Was it here? Okay, let's see. Well, let's see. BP oil spill. When was this? Deep Horizon oil spill, blah, 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 20th of April, what year? 2010. Okay, there you go. So, here's BP, here's 2010. La-di-da-di-da, this is a financial crisis. La-di-da-da, they're recovering. Then, from 60, really fast. So look at this, see? Here is week 1 of the crisis. Here's week 2, 40. So there's your 30%. There's your 30-something% drop. Now look at week 3. Another. Eventually they end up 50% down from where they started. Okay, so you're right here maybe in Volkswagen. You're somewhere in this range. And well, I guess I can find Volkswagen. What are they? Damn it. VLKAY. VLKAY. If it'll chart it. Yeah, it's like funny about those things. What? Okay. So Volkswagen is only down, $15 out of 50. They're down about 33%. So the next leg, and don't forget, look here, they not too long ago were down to 25 anyway. I think they're probably going to come down around 20. Well, they are at 25. Sorry. I'm sorry, my mistake. They're already down at 25. Wow. So they have dropped 50% from their high. I'm not sure when the scandal really came about, though, because they were dropping anyway just due to overall weakness, and this just is not helping at all. They certainly probably are. I would say they probably are getting into bargain territory at this price. Like I said, they made $13 billion last year, and now the company is down to $60 billion in value. So their PE is roughly 5. All right, so yeah, long term, they're basically giving up a year's earnings. But as long as they survive, it doesn't matter. They're capable. Now, you look forward and say, okay, I don't think they're going to make that much anymore. The people are going to be mad at them. They're not going to buy cars. It'll take years for people to forget. I would probably cut my estimate down to $6 billion for earnings, and that's real conservative. But let's say they have $6 billion a year going forward, and let's give them a 10 PE, so $60 billion. So basically right now, 25, this is a fair, conservatively fair valuation for them going forward. So if you can now turn around and sell puts that put you in at 20 or 15, I would think that's probably a good thing to do. I think probably around now is good, but I wouldn't overcommit because they could still drop further. If there's more fines and bigger numbers and so on and so forth, if people get arrested, there could be turmoil. You could see these guys down at $15. So would I take a poke at them here? Yeah, I wouldn't mind taking a little poke at them as long as I can sell like the $20 puts for at least $3, so you're going to average in at 17. Then I wouldn't mind selling some $20 puts and taking a stand, but only on a position where if they went down to 12, I'd be happy to roll the position and double it down. I wouldn't do it under any circumstances if anything would make you stop out of this position, because they could get hit really hard and go really down for. They can get hit hard and fast with China can say we're going to fine you $10 billion. They don't have to have a good reason for it. China can say you had 10 cars, we're fining you $1 billion each. What are they going to do? This is a big thing. BP was contained in the United States, where we have all kinds of very strict rules about this stuff. Volkswagen selling cars all over the planet, and they're subject to everybody's laws. They're going to be in court for decades on this thing. It's not good. Anyway, so I would take a poke, but I certainly wouldn't put a lot of money into it, and I wouldn't do anything that I couldn't double down on, and not even worry if I lost the double down amount. That's how bad what they've done is. All right, how are we doing the time? I think we must be way over. Oh my God, it's 2. Now it's 2:30. I'm supposed to end these by 2:30. So I'm going to give quick yes and no answers to the next bunch. Yeah, you got an order from India. Well, they always get orders. But BA they've got 10 years of back orders on their planes. It's never going to be about whether or not they're going to sell planes or whether they're going to make money. It's never that. It's really just about as long as they're accident-free and problem-free and don't have recalls and don't have big issues. That's it. If they make good planes, they keep cranking them out. That's great. It's a shame because don't forget, you're used to the era of the 747. Where they had a plane they designed 30-something years ago. They had worked 1,000,000% of the bugs were worked out of that plane, and they kept selling them. And that was their big money maker. They never had a problem. They never had a delay. They knew exactly how to crank them off the production line. 747s, 727s, 7 whatever. All those planes were very much the same. Now they've gone to new materials, new planes, new configurations. They're going to have a few more problems in their production line than they had in the past. But they're also the greatest engineers in the world. So, it's not like I don't like them for that reason, but I just think you got to be a little bit cautious always with things like that because you never know. As proven by the battery problem they had. I mean, that was just a design flaw. It's possible. Any one of 1,000 components can go wrong. So what do I think of the BMW on the Volkswagen pullback? I mean, look, it's going to give an advantage to other car makers. I think all of them are going to be a little bit stronger, and I think the fact that the other car makers are selling off with Volkswagen, when I very much doubt that they've got the same problem, I can't imagine that this is a normal thing for these car companies to do. I mean, I can't imagine that as a practice they're defrauding the governments. It would be too much. I mean, really, you just got to give up on humanity if that's a widespread thing. I like Ford. I think I said that at the beginning. We didn't follow up on it. But I like Ford, and Ford came down a bit, I'm sure. We always like Ford below 15, and now they're at 1383. So this is undeserved. Ford's just sitting down with the whole industry, and we'll like them for a pickup. But BMW too, sure, great company. Paul says, I followed the U.S. Euro indexes today. Italian MIB seemed to lead all the moves, looking at the 5-minute any logic to that. Well, the Italy went down the most. Yeah, they're in the worst shape. That country is not much better than Greece. I mean, it's just, all these countries are a lot weaker than you think they are. Everyone's being propped up by the central banks. That's no way to run an economy. So you're going to have a lot of problems in all these countries, especially if Draghi and Yellen don't do something Thursday, we're going to have a really rotten weekend. I'll tell you that right now, because durable goods orders are going to come out in the U.S. and they're going to suck on Thursday morning. I mean, how could they not suck? Every single Fed report we had, Richmond Fed, New York Fed, Philly Fed, the one we had today, whatever that was, all these different regional Fed reports are coming out with terrible numbers. So how is durable goods not going to be terrible? It's not even imaginable how they're not going to be terrible. And then everybody's going to panic. So we have that to look forward to on Thursday morning, barring Draghi stepping in with something and barring Yellen stepping in with something. What do we think about J&J as non-discretionary? I like J&J except for they're very sloppy in their medical devices. They've had many recalls and problems. They run that division very, very poorly, and it's a lot of exposure. If they would jettison that division, I would love that company because they make a ton of great products, but they mess around with these medical devices, and they don't really know what they're doing. They cause a lot of problems. But generally, it's a good company. If they're on sale, I like them. But, look, we haven't had a big sell-off yet. We haven't had a really big market capitulation yet. So unless somebody's off at least 20% off their highs, I'm really not a buyer. They're not. They're off 10% off their highs. Okay? Here, this is where I like them. In fact, the answer to any stock question is where they spike down to here is where I kind of like them. And we're talking about back where we were in 2014 before that round of QE kicked us up to here, because this round of QE is bogus. It's not the reason you should be buying stocks. The earnings are still here. These earnings are still what people are earning. They bought back their stock. They've done all this stuff. There's been accounting shenanigans. There's all these different ways they boosted earnings. There's been free money thrown in by the central banks. They've gotten super low interest loans. It hasn't helped their sales, and it hasn't helped their profits. The dollar profits are the same. They're just dividing them by less shares, and that's not a reason to jump into companies. So at least I want to be able to engineer that price. So I want to sell 85 puts or something like that. But even so, I just don't think the market is that strong. This line's coming down. And unless they pull over the 50-day moving average, I don't see them as being attractive. And even if they do, then I think they're a bit overpriced. There are definitely bargains out there. Look for guys who are back at their 2013 level. Look at people who are down at this area, where 2013 ended. And that's probably, for most of these big cap companies, that's about where they should be. All this is just nonsense. It's a big pump up, and now it's deflating. That's all it is. So when they get to those prices, then it gets interesting. So we had a market crash when the Fed was 0% besides 1987. Oh, have we had a market crash when the Fed was 0? No, but that's, not really the point. It's, look, the Fed's never done this before, but I think the worst thing about this is not about the Fed being 0. It's like, what are they going to do? Are they going to start paying you to borrow money? Because if we have a crash now while they're at 0%, what is the Fed going to do to fix it? The only thing they can do is pay you to start borrowing money, which means now if they're paying you to start borrowing money, that means the bank's is going to start charging you money as negative interest. That's what that translates into. So in other words, they're going to take your retirement savings, and again, this is why gold and silver are a winner, because if the Fed starts going negative rates and savings start going negative, and the bank says, we're going to keep your money, we're going to give you 0%, and we're going to charge you 1% fees to hold your money. You're going to actually hear those words come out of the banks if the Fed goes below 0. So you're in an economic crisis, the market's crashing, people want to go to cash, and the banks are going to start saying, okay, you know what, you know that cash you have in our bank? We want to charge you 1% for keeping it there. That's what negative rates entail. So think about that environment. Where are you going to put your money? People are going to fly into metals and fly. You're going to be looking for places to get your money. All of a sudden, getting 0% on a 30-year bond is going to look good. It's like 0 is better than negative. Can I give you a quick thing on the 5% rule? No, I cannot. We keep doing that. There's in our education thing. I'm pretty sure there's things, or in the Wikipedia. There's certainly stuff on we have a PSW wiki on our site. There's definitely things there on that. Risk. What max percentage of portfolio should ever be in one stock? Tom, I would say 10% is really pushing it. Although, frankly, we have actually run 20% Apple, but only because situation warranted it, like Apple went way down and we doubled down on it or something like that. But generally, I would never want to have more than 10% in any single stock. That's just way, way too dangerous. And yes, you need to look at your portfolio. And by the way, 10% is a lot too. I mean, really, 20% should be the max for any sector. And then in any given sector, you should have at least 3 or 4 or 5 stocks. So, in general in portfolio, I don't want to have much more than 20 stocks, 40 stocks. 40 stocks for a portfolio where at least half the stocks are stocks you never need to look at, like really long-term plays. But active plays, 20 plays max. Otherwise, you just don't have time to deal with it. A human being cannot really look at more than 20 things effectively. I get strained out. When it's more than 40, I get strained out, and I'm really good at this stuff. So I seriously wouldn't want to put too many stocks out there. And then, so basically, though, you want to take your total your buying power. Okay, so if you have a normal account, you have $1 million and you have $2 million buying power. You want to divide that by 20 at least for 20 positions, and that means that in a $1 million portfolio with $2 million in buying power, you're going to have about $40,000. No, $50,000. No. Do the math again. You have $100,000 max per position to spend, but generally you don't want to spend that. You want to spend 50,000 blocks, but this is now getting more complicated strategy. I'm sorry. When you have that much money, it's more complicated. If you have $100,000, that's the easiest way. You're going to have 200,000 buying power divided by 20. That means your blocks are $10,000. So each allocation block you have is $10,000. So if you're selling puts, under no circumstances do you sell more puts than would cause you to have $10,000 of stock allocated to you. That keeps you in that 5% range, okay, which is where you want to be. If you get then assigned the stock and then you want to sell more puts and lower your basis and then you get assigned again, then you're into 10% by accident. But that should be like years out after a huge drop. You never want to aim for more than that. That's crazy because then you can get in big trouble real fast. All right, last couple of things, and I got to get done. Wow, why can't I do this? So confusing. No options fill. I don't know what that means. Oh, you're not using options. Well, still, you shouldn't do more than 10%. Or you're saying VLKAF has no options. I'm sorry, you're confused between all the different questions. No, I didn't say there were options. I'm sorry, in Europe, I'm sure there's options. I was talking about Volkswagen in Europe, not on VLKY. I'm not even talking about trading it here. I wouldn't touch it. It's an ADR here. But if you're in Europe, then there's got to be options. Are you interested in playing the futures at these levels still away? No, I'm not interested in playing the futures because we're sort of in between right now. It's very hard to tell what's going to happen. As I said, the way we're finishing right now, it looks like we're going to finish lower than 2%. If we finish lower than 2%, we're probably going further down tomorrow. If we finish higher than 2%, we're probably going to recover a little bit tomorrow. But either way, look, I like cash. If we see a good setup, then I'll call it out. But at the moment, I just really would much rather be in cash. Where do you see SQQ going for the hedge? Well, I mean, I don't see anything. If we go lower, it's going to get much higher. I don't know where it is now, but let's see. So SQQ is at 25. Look where it was last time. It was at 30, 35, but let's say 30 is realistic. In the portfolio, we're talking about the 5% portfolio. Geez. See, here's the long-term portfolio. See, there's 26 short puts in the 5% portfolio. So we do one, not every week, but almost every week we'll do one of these, or every other week I'd say we do a short put. And we let them rotate through. And all this money, which is a lot of money, it's like $100 and something thousand, $150,000. If the market goes up, we just put that money in our pocket. Then as far as actual positions in the long-term portfolio, that doesn't count. That's just a dead stock. We have 1, 2, 3, 6, and 14 is 20, right? There you go, 20. And it's a lot to me. I don't count these. These don't matter because they're not a position. They're just stocks we promise to buy if they get cheap. So we don't worry much about those. These are the guys we actually manage, these 14 spreads. Those are the ones we're looking at actively. These are our covered calls, which are long-term positions. And that's the way we run it. And right now, the long-term portfolio is up. See, the positions we have now, because we sell so many puts, are negative $182,000. We've got $882,000 in cash. We have a $700,000 total value in the portfolio, which is up 40%. Now, all we have to do, though, if the market just goes flat until 2017, we're going to collect that $182,000. That then drops to profit, and it's already in cash. It's already the cash. But what will happen is this will go down to zero over time. This will go up to 882, and then we'll have gained another 40, almost another 40%. It's a very passive strategy. It lets us gain a lot of money. And all we're doing here, the main thrust of the portfolio strategy is I'm saying if Alcoa is below 13, I'll buy it. If these guys are below 110, I'll buy them. If they're below 23, I'll buy them. If they're below 37, I'll buy them. If BP, in fact, if BP is below 45, we'll buy them. Now BP is below 45, but we sold that put for $8, so we only paid 37. They're at 30, so it's losing right now. But I don't care. It's 2017, and when we get to 2017, we can roll those puts to 2019 at a lower price. So it's not a hard promise that we're making. But meanwhile, if the market does recover and starts going up, we already have all these positions already long. If the market doesn't recover, then we've got a lot of cheap stocks we're going to get into. And that's what we do. But the cash is already in our portfolio. It's $882,000 cash in our portfolio. That increases our buying power to $1.6 million. So we've got margin coming out our butts. We can afford to play this game. That's our long-term strategy. Then our short-term portfolio, the short-term portfolio protects that. Now, because we're bearish in the short-term portfolio, that is up outrageously. It's up 248%. We have 348,000 there. So that's what, like just about 1,050,000 total, which is great. We started with 600,000. So overall, we're up, what, 40 into 600 is what, 60% or something like that. So overall, our two portfolios, we pair the long and short portfolios, which are paired portfolios, they're up 60% since, when do we do it? Since November of 2013. So that's all of 2014, almost 2 years. So they're up about 30% a year, which is good. It's well ahead of what we're aiming for. We tried for 20% a year. We're up 30% a year. The short-term portfolio is active. We really cut down on these. We only have a few positions, and most of our positions are, we have that's a bearish play, a hedge. That's a hedge. There's another bearish position there. That's a bearish position there. Is it? No, this one's bullish. Sorry, that one's bullish. Then we've got these FXPs that's bearish on China. And here's a silver position. We're long on silver. Here's lumber liquidators that we're long on. That's it, though. We're not long on anything in here. We're really bearish in this portfolio. And meanwhile, it's up 248%, so I guess that was a good idea. Now, we sold all of our bullish positions. Everything that was bullish is gone pretty much from this portfolio. And all we have left is the bearish positions. But those bearish positions are protecting the long-term portfolio. So when the long-term portfolio goes down, this guy goes up, balanced. And I just want to maintain my $1 million worth of cash. That's what I care about. You know, when you're up $400,000, just protect the money. Now, the 5% portfolio, that's what he asked about SQQQ, although we have it there too, I guess. In SQQQ, we took the October 23-27 bull call spread to help protect the portfolio. At the moment, we're not showing much of a gain. It's $251.40, and it was $2 whatever. But the reality is, again, now you've got into this option mispricing thing, because the reality is these calls are $2 in the money. $2.10 in the money. The net of the spread is only $1.10, but really it should be $2.10. That's $2,000 more than it's showing. Okay, and $2,000 more brings us back to where we want it to be at 9.5%. So when this expires, it's going to be a lot better than it is now, unless the NASDAQ recovers. If the NASDAQ recovers, then our long positions are going to be in better shape, and we'll be happy about that. So we're balanced out here because we already made a lot of money, and I'm sure we'll find something else exciting to trade, but right now we're just happy to be balanced in this portfolio. And it doesn't look balanced, again, just because you get bad prices in the interim, but the reality is this trade, if it closed today, would be would be $4,200, and currently we're only being credited $2,200. So we're being ripped off by $2,000 on this spread. All right, but we know how it works, so we're not concerned about that. So what was the actual question about the SQQQ? So where do we see where do you see the SQQQ going? Well, like I said, on that chart, on this one, you can see SQQQ went up to 30. It's not, again, if you've got a bet, and you can take $1,000, $2,000 profit off on the bet, take the money. It's not a bet for us, it's a hedge. We're protecting our long positions because we have long positions that were up $10,000. So we took a hedge that will make $7,000, $8,000 if the long positions fail. So that keeps us even. And that's all we did this for, to lock down our portfolio to even. We weren't trying to make money on SQQQ. That wasn't our goal. Our goal was to lock in our profits. So we took a very small percentage of our profit to lock in the profit on that portfolio. And again, this is important. You can't just follow trades. You have to understand why we made the trade and what we're trying to do with it. And that was a hedge. It was not a bet. Do you think REITs are a bad thing to be invested in? No. We just added ARR, which is Armor Realty. That's one we like. We kept saying we added because it was Talk Like a Pirate Day was like Saturday this weekend. So it's like, R, it's a stock, and I like that. So it's a good stock to be able to talk about when you get to the Talk Like a Pirate Day and talk about your portfolio. It's a good REIT. We like them. We like CIM. We like NRF. We like MLY and AGNC. So those are some REITs that we actually like. And then basically, which one do we like the best? We like the one that gives us the best price options-wise going forward. What do you think of EEM? Is it hated now? No, I wouldn't touch emerging markets. You're looking at a possible global financial meltdown, especially centered in the emerging markets. It's a terrible time to be looking at that trade right now, unfortunately. If you choose silver wheat and if you silver play, yes, we have silver wheat and we do choose it in our portfolio. And Declan says, thanks, and I say thanks, and now we're done. Thank goodness. Holy cow, that was a long time. All right, let's take a quick look at the index and see where we are. We're finishing again. What I say, if we're down below 2%, we're okay here. We're okay here. We're poking up on the S&P. NASDAQ, no. Russell, no. It kind of depends where he finished. You want to see, that's where this line now is useful. Here's the 1925 line-ish. And so we want to see if the S&P can manage to get back over that and stay there for the close. The Dow wants to get back over 16.2 if it can. And if we see a little bit of signs of life here into the close, well, it's hard to even count it because it's kind of fake when you get a rally into the close like this, but we'll see what happens. But if we're under 2%, if everybody here, if these guys get lower and they're below 2%, then I think doom tomorrow. Then I think you damn well better make sure you have plenty of hedges. You know, like obviously from our portfolios, we have plenty of hedges. We're not worried about it, and also we've got plenty of cash. We have more. Look, in the long-term portfolio, we have more cash than we do value. In the 5% portfolio, which is called the Options Opportunity Portfolio now, we have $92,000 of cash. Okay, so we're all, you know, mostly cash there. The short-term portfolio, I bet we also have more cash than, let's see, in the short-term portfolio, look at that, that's a rarity in the short term. We're hardly using any margin at all. We're just all cash. In the short-term portfolio, we really are in cash. We've got $300,000 cash, $348 total value. So again, almost all cash, like 90% cash. And even the butterfly portfolio, let's take a look at that guy. My favorite portfolio, by the way, absolute favorite, up 80%. Gotta love it. So in the butterfly portfolio, $175,000 cash and $180 in value. So we're 99%, 95% value of cash in this portfolio too. So we are heavily, heavily, heavily in cash. All right, and these are all self-hedging positions. That's why I love the butterfly portfolio. We do have to adjust, though. We are going to go through this tomorrow because some of them we didn't actually sell calls. There's a couple of positions that aren't filled yet. And when we're up 80%, why should we mess around? It's like, why take chances? All right, it's like there's no reason to be taking chances when you're up 80%. All right, so we're going to look at that very carefully. This is supposed to be a very conservative retirement portfolio that for you can say unfortunately, but fortunately, unfortunately, whatever, it's up so much that we have to protect it now. It's silly to be up this much when you're supposed to be playing conservatively. So we have to take a close look at everything and figure out what we're doing. All right. Thank you all so much for coming. It has been fun, and we will get back to our regular member chat room now, and we'll do this again next week, except next week will not be free. Sorry. All right, but you can always join. If you want to do these every week, you can join, and then you get all the chat rooms and everything else. All right? Thanks, guys. Take care. Oh, wait, one question. Let's see. What's it say? Question, income opportunity portfolio, Phil. What's the minimum size portfolio I need to try to make some income? It's option opportunity. It's not income opportunity. And it's actually gauged at $100,000. But generally, most of the positions you can take, obviously, if you have $10,000, you would take one contract instead of 10 contracts. Although, if you have $10,000, you can't trade on margin. So really, you kind of want to get closer to like $50,000 at least, or you're not going to have a margin account to trade with. How much does it cost to do butterfly portfolio? You can actually follow the butterfly portfolio even if you got the Trend Watcher membership. You'll see it, but you won't be able to chat about it. If you want to chat about it, you need the basic membership. All right, so those are check Phil Stockwell. You'll see the prices on those sites, on those memberships. All right, thanks for coming, everybody. There will be archives of this thing, and and by the way, thank you to our archiving crew who are fantastic. Now, when you get the archives, you can see, like every time we finish these, you can see exactly what we said at each time frame. So that makes them really useful for you guys to be able to go back and look and see when we talked about so and so. All right. Yes, all Apple puts it cheap, but I still think Apple can go lower. I think the whole market's going to sell off a bit, so we'll see what happens. All right. Thanks, guys. Have a great day, and we'll talk to you more later. Oh, May says, is there a number to learn more? It's just call Phil Stockwell. Not call Phil Stockwell. Just contact Phil Stockwell. There's a Greg, Greg, at philstockwell.com. He's our administrator. All right, thanks. We're not a pushy service. We don't have like phone up people or anything like that. We're just, hanging out and letting people learn. Thanks.